Good morning or good afternoon, and thank you for joining us at this online event. My name is Ulla Fetzer, and I am a client portfolio manager at NN Investment Partners. Today, we host the second event in our Get Ready series, a series of 3 interactive sessions designed to help investors get ready for the most pressing topics and biggest opportunities in 2022. The topic of today's session is Get Ready for the Best Opportunities in Alternative Credit. With us at the table today, we have Trevor Castledine, Senior Director, Private Markets at B-Finance, and Dr. Klaus Michael Menz, Head of Credit at Gothaer Asset Management, who are both joining us virtually. And here with me at the table, we have Ronald Verhagen, Consultant at AF Advisors, and Niels Bodenheim, Head of Alternative Credit at NN Investment Partners. Welcome and thank you for joining our webinar today. But before we begin, some quick housekeeping rules. This broadcast is not only live, it's also interactive. So we welcome your questions to us and ask our speakers in the chat. Since we have a full program today, let's get started. To introduce what we do in alternative credit at NN Investment Partners, let's watch a short video.
Alternative credit. You may think of it as the big unknown, a black box. But if you allow me, I'd like to show you that it is actually a very tangible asset class. In fact, alternative credit is all around us. It is about financing parts of economies and making social and environmental impact. You could say that alternative credit investments help to make the world go round. Let me show you how. At NNIP, we have 7 strategies under the alternative credit umbrella. They are listed and non-listed debt instruments, each offering a combination of yield pickup and downside protection. Take infrastructure. Infrastructure assets are essential to the functioning of modern-day societies. NNIP's Sustainable Infrastructure Debt Strategy provides senior financing of infrastructure projects in Europe that contribute to a more sustainable economy and prosperous society, like roads, wind and solar farms, but also schools or hospitals. Or asset-backed securities. Asset-backed securities are securities backed by a pool of income-generating assets, such as credit card receivables, residential mortgages, student loans and auto loans. It's probably the most tangible of all the strategies and helps day-to-day life to move forward in all parts of society. Let's take a look at Dutch mortgages. This unique market stands for a strong credit profile, attractive spreads, the strong payment morale of Dutch borrowers, low historical losses and strong investor protection. Up next, commercial real estate. Commercial real estate debt is mortgage-backed financing on income-producing commercial real estate assets, such as office and residential buildings, or logistics parks, or shopping centers. Then, let's take a look at trade finance, a centuries-old global market financing global trade traditionally dominated by commercial banks and now opening up to institutional investors. Trade finance is characterized by low losses, high recovery rates, and can even have a positive impact on the UN Sustainable Development Goals. On to ECA loans, a way to encourage trade. ECA loans can be accessed in many different markets, such as global export finance, infrastructure finance, or lending to sovereigns and SMEs. And finally, corporate loans. Within the corporate loan universe, we invest in loans that finance social corporate purposes, specific assets acquisitions, and international trades. 7 strategies, each offering different advantages to investors, but all impacting our everyday lives.
But first, before diving into the opportunities alternative credit offers, it's essential to look at the current situation, which is characterized by many challenges and uncertainties. Still low interest rates, a clouded outlook when it comes to the uneven reopening of economies, supply chain bottlenecks and delays, uncertainty around inflation or stagflation, and finally, an increasing market volatility. And then there is the continuously increasing importance of sustainability within the investment industry. Well, but is really everything gray and dreary, or are there still opportunities? So, let's dive into the topic of alternative credit. Would you say alternative credit is an attractive opportunity? And since this is an interactive session, we would like to start with the first poll of today. Dear audience, what are your expectations for market allocations towards alternative credit in the coming year? Decrease, stable, increase. You can vote via the poll on your screen. While we wait for your answers, we will start discussing the first topic with our speakers. So maybe let's kick off with the investor in our round. Michael, can you tell us a bit about the investments you have made at Gothaar? When have you started, and what were the key drivers for you to go that route?
Yes, sure. I guess we came across this route very early when bonds for the first time dropped below the 1% level. That was, I guess, back in 2014, and then it made necessary to find new opportunities and overthink the traditional fixed income market opportunities and find new ways, and therefore we started to investigate the Dutch mortgage market as one of the most important and most accessible markets in Europe when it comes to mortgages. And we started to invest there in 2015 and made our first, let's say, capital calls then in the beginning of 2016. And yeah, as I mentioned, I guess the reason behind it was not only the yield level environment that has been so awfully low for now, I could say decades, and it's still very low, but also on the credit side, where premia have vanished and overall compensation has been so depressed. For example, formerly we had new issue premia that nowadays for new issuers have been completely vanished and became even negative. For first-time issuers, we had some premia received in former times, and these have vanished as well and became even nowadays negative in some instances because people are seeking some diversification, and therefore it was the overall need to earn additional premia, and this led us to seek opportunities in the more illiquid and more complex space.
Well, thank you very much for this insight, Michael. Maybe to move on to Ronald. As a consultant, you support many institutional investors in the Netherlands in achieving their goals and finding the right investment. So is there anything to add from your point of view?
Well, thanks, Ulla. Well, first of all, if I may, I would like to say something about the word alternative. It makes seem the investment category quite exotic or maybe even risky. And I would like to say that many sub-asset classes in the alternative credit space are actually quite conservative with long track records and frankly maybe quite boring, which can be a good thing for investors. And furthermore, institutional investors have ample experience investing in alternative credit. Our company, AF Advisors, did a survey under institutional investors some years ago, and almost every single participant, so institutional investor, has experience with investing in alternative credit. So, moving back to your question, and adding on to Michael's answer, I can distinguish between 3 additional advantages for institutional investors when they are looking into alternative credit. So first of all, there are diversification benefits. Many alternative credit strategies have low correlation or relatively low correlation with public debt, so that adds diversification benefits to the portfolio. Furthermore, Michael mentioned the illiquidity. There's also an advantage to volatility when it comes to illiquidity. This is because of a lot of technical reasons. I won't dive into the details too much, but one simple explanation is the pricing interval of alternative credit strategies is quite longer compared to public debt, which is continuously priced. And finally, liability matching. Many alternative credit strategies have predictable cash flows, and this means this can be lined up with the liability structure of the institutional investor. To sum everything up, when institutional investors are looking into alternative credit, the primary reasons to deciding to invest is frankly the same as with traditional asset classes, and that is the risk-return trade-off. That's our experience. However, their challenge is the specialized skill needed to assess alternative credit instruments, and well, that's where we come in as a consultant.
Thank you, Ronald. Well, Niels, now we have heard the investors' approach, we have heard the consultant. So, what do you think? How does the current market environment suit illiquid investments?
Yeah, the current market environment suits illiquid investments very well, at least on the alternative credit side, because as Ronald indicated, even liquid markets can become illiquid in volatile times. And so then we go into a little bit more of the details that were referred to of why illiquid investments in alternative credit provide a nice downside protection, or also with the benefit of an inflationary hedge in a dynamic market. Specifically, we've seen a lot of investor interest and allocations into floating rate debt instruments within private debt, in particular ABS and corporate loans. And so those are underlying product solutions which provide protective elements. But we're also seeing the underlying collateral positions being very defensive in these illiquid asset classes. In our real asset categories, we have instruments like infrastructure debt, infrastructure underlying positions, the generating cash flows are protected by contracts or regulations and concession agreements that also see price movements going up, allowing the borrowers to better service their debt in uncertain times. With that, we see amortization and appreciation of real asset values, also de-risking portfolios. So both by product nature and underlying collateral positions, illiquid assets actually become quite defensive and well-positioned in uncertain times. And that's both for short duration and long duration instruments. And we noticed last year a lot of volatility, but at the same time, private debt offered very low default scenarios and very good recoveries if there were moments of stress. So all in all, I think illiquid asset classes of alternative credit suit the current market conditions very well.
So you might say there will be growing investor interest in alternative credit.
Let's see what the survey says.
That's actually very good because I guess we now have the results from our first poll. So let's have a look. That speaks quite for itself, I would say. And I'm not surprised to see that, if I may add. So we see the audience expects that alternative credit allocation will increase. Trevor, can you reflect on those results and tell us something about the trends and actually your expectations for the future?
Yeah, thank you very much. I'm not surprised at all by those results. It totally reflects what we see with our clients. We've seen increasing allocations, and I think we will continue to see increasing allocations. And that includes people who already have an allocation who are wanting to expand it, and people who are maybe moving into new categories of alternative credit. And just to build on what's been said by my fellow panelists already, I think the low rates on traditional credit, and when you say alternative credit, I mean, I just think it means non-traditional rather than kind of weird, if you like. Traditional credit is traded bonds. Traded bonds deliver incredibly low returns at the moment, quite volatile. And I think the big concern is actually that the returns on that are going to start to go up. Because when rates go up, the capital that you've got invested in those bonds is going to get destroyed. So unless you're locked into a sort of formal LDI program, pension, like a closed pension fund, you should be really concerned about that potential trend of increasing rates. So, I think that for all sorts of reasons, more money is going to go into alternative credit. And we see the global picture. I think there's slightly different trends from slightly different countries or regions. It's never wise to generalize, as they say, but I'll give it a go anyway. I mean, I think in the US, people tend to have higher return targets, higher appetites for risk, and maybe they're looking for more leverage or higher risk strategies. That's where they're moving. I think Europeans tended to be more conservative, typically have lower return targets, and therefore are probably moving towards slightly less lower octane strategies, if anything, but still there's plenty of capacity there. Within Asia, traditionally investors have been stuck on sort of stabilized real estate debt or infrastructure debt, which has had pretty low returns, but we're seeing increased appetite there for maybe corporate lending and things of that front, of that nature. And finally, like in the Middle East, where investors might be constrained by Sharia rules, it doesn't necessarily make it obvious to invest in credit, but they are supplementing their portfolios with things like trade finance, equipment leasing, and other strategies that can be implemented in a Sharia compliant fashion. So I think across, the trend is more allocation for sure, and I think there's a strategy that fits you. Maybe we'll talk about different industries later, but certainly whatever your targets, there's a strategy that can fit in your portfolio.
Well, thank you very much. These were some very interesting insights. Actually, we just have received a question in the chat for you, Trevor. So I'll make use of the occasion. And the question is, will alternative credit ever become broadly available for retail investors?
My sort of slightly sarcastic answer to that is only where regulators stop implying that every investment needs to be traded every day. As all of the panelists have already said, alternative credit is illiquid, and there's no point in trying to pretend that it's not. And at the moment, the vast majority of regulations and risk management around retail investors is that they have to have daily pricing and daily tradability. And while that continues, you're not going to get access to alternative credit. I think, by the way, it would be a great addition to long-term savings for retail investors, and a great thing to invest in maybe in your retirement, where you want to turn your investments into reliable cash flow. But the only people stopping it are regulators. and so they need to take a look in the mirror about whether their regulations really are serving the best interests of retail investors. I think.
So I hear more work needs to be done on that side.
Yeah.
So maybe let's move on and do. We already started a bit, but let's start with a deep dive into alternative credit sub-asset classes. So we already heard it offers a broad variety of solutions, each sub-asset class with its own unique characteristics. And why don't we look into these characteristics and opportunities of these sub-asset classes? And that's actually also a question we would like to ask you, dear audience. Which sub-asset class offers the best opportunity? Is it infrastructure debt, export or trade finance, commercial real estate debt, corporate loans, residential mortgages, or distressed credit? And again, while we wait for the results, we will discuss with our round here this topic. So we heard it's a diverse market that offers a range of interesting investment characteristics. Ronald, since the alt credit space is so diverse, can you share some insights about the distinctive characteristic of the sub-asset classes?
Sure. So there are many ways to distinguish or categorize the sub-asset classes of alternative credit. We can sort them from conservative to risky, like distressed loans or leveraged loans. You can go from low duration, such as floating rate loans, to long duration that are residential mortgages, for example. But to make things more simple, I like to distinguish between two lines in the alternative credit space. So the first line is the consumer loans and corporate loans line, and the second line is with and without physical collateral, such as, these are real assets. So to give you some examples, in the consumer loans, you will find student loans, credit card debt, car loans. These are generally quite risky investments that demand a high return. When you move over to the physical collateralized consumer loans, these are residential mortgages. Almost every pension fund in the Netherlands is invested in residential mortgages right now. Moving over to the corporate loan side, loads of different strategies are there. Senior secured corporate loans, leveraged loans, distressed debt, structured finance. These are without physical collateral, but they're not without any collateral. Most of these loans are collateralized, but they're backed by the company's asset. Then the physical loans on the corporate side, here you will find commercial real estate debt and infrastructure debt. And I think especially this last category, infrastructure debt, this provides huge opportunities for investors in the coming years, facing the energy transition that we're all trying to make in this world. This is a big and growing market, so we'll hear about this a lot in the next few years.
Thank you very much. Trevor, maybe you can share also some thoughts on whether certain parts of the alternative credit space are better suited for different investor types. And are there actually any hurdles that investors do have to overcome when entering this market?
Yes, of course. I mean, I think that as we've already mentioned, and as Ronald said, that there is a huge spectrum of different risks, risk-reward combinations that you can access. And so clearly, depending on who you are and what your targets are, what returns, what your appetites are in terms of risk, you can find something that suits you. I mean, just to take some industry examples, with insurers, where maybe you're constrained by regulatory capital, there may be a requirement to be relatively short maturity or liquid. You're probably used to investing in bonds, so you're not used to a great yield. You might start at the lower risk end. If you want liquidity or short maturity, trade finance is a great thing to look at. If you want perceived safety, then as Ronald says, loans backed by real assets, stabilized real assets might be a great place to be. If you're a pension fund, looking for reliable cash flows, but maybe at a slightly higher level than your bonds, maybe you look at corporate loans, because you're going to eliminate a lot of volatility from your asset value. You're going to get reliable cash flows. But others, if you've got a higher risk appetite, if you're an endowment, a family office, a wealth manager, a sovereign wealth, maybe you're looking towards higher return strategies, special situations, mezzanine debt, niche, maybe some of those types of infrastructure and real estate debt that focus on the construction phase rather than the stabilized assets. So there's a whole variety of things that you can do to suit your own risk reward requirements. I think in terms of the hurdles that you asked about, implementation is the key right here. And to the extent it's a new asset class, there are going to be internal and external stakeholders to convince, whether that's your investment committee, whether it's your risk department, whether it's trustees, or even your legal department who's not necessarily familiar with the documentation. So quite a few hurdles sometimes in terms of education internally, maybe even externally in some cases. And then some practical considerations like, whether your custodian, is capable of actually providing, the custodian you use for your bonds or your equities, are they actually able to provide the same service for private assets, for alternative credit? So that's a potential practical issue. The final point I'd make is that the biggest implementation hurdle with illiquid assets sometimes is staying invested. And new entrants to the market perhaps don't realize that you still have to be quite active in managing these illiquid assets, because if you want to get your desired allocation in the ground and you stay allocated, you need to be monitoring the repayment profile and making sure you're committed in a regular basis. And I do think that investment managers actually can do more to facilitate this for investors by developing the fund structures they offer. Because at the moment, quite a lot of these fund structures are sort of traditional closed-end vehicles, and I think we need to see development there into more evergreen or open-ended structures.
Well, that's some interesting comments you made. And as you also mentioned, insurers, maybe that's a good point to address Michael again. Can you share something about your current allocation towards the different sub-asset classes, and what do you expect for the future?
Yes, I can, and I guess it's no secret, because I guess many papers and journals have already reported that we have been early movers when it comes to alternative credit back then in 2016 on our exposure to mortgage loans, which has now quite become huge, and therefore I guess I would regard ourselves as fully invested when it comes to our asset allocation with respect to at least Dutch mortgage loans, Dutch residential mortgage loans. But as we regard the asset class in general, still very much attractive, as Ronald and Trevor already pointed out, we are seeking now to add some diversification when it comes to geographies, meaning that we are keen to add exposure more in other countries and their respective mortgage markets. In addition, what we are keen to enhance is our exposure to trade finance, and there are two parts. On the one hand, of course, the more shorter duration, self-liquidating trade receivables business, and factoring style investments. And on the other hand, also as a substitution for low yielding sovereign yield, the state guaranteed export loan business, which we all or still regard as attractive as an addition. And finally, also on the commercial real estate loan business, we are also keen to add there more. And to sum it up, I guess our asset allocation still points to further increases, and I guess therefore we are very much, I guess, in line with our audience that is also keen to increase their exposure going forward.
Thank you, Michael, for sharing that. And I guess that's, again, a good bridge talking about increasing the allocation and also diversification to share the results of our poll and have a look at the poll results. And this time, it's not as, well, significant, or there is not one outlier, let's put it that way. So we see infra debt with 19%, export trade finance 24%, corporate loans also, but mortgages, CRE debt, and distressed credit. So it's I think it's very interesting outcome. Niels, looking at that, what do you think? Which sub-asset classes do you think are attractive opportunities?
Yeah, well, I was quite surprised to see the trade finance high on the list. It's still often seen as a very niche asset class for institutional investors. It is one of the largest and longest running corporate finance solutions around. And also driven by the dynamics and change in banking regulation, has it provided a shortfall in financing solutions. So from an investor perspective, institutional investor perspective, it's quite a unique way to access private debt in relatively short order. From a deployment perspective, there's actually quite speed and ramp up feasibility. We saw quite a bit of activity and deployment last year at premium pricing. We're seeing that again in this year as well in various solutions. It provides global diversification solution, and it's also self-liquidating, short duration financing that either through receivable or trade can cycle through within 3 months or 6 months or even shorter. And so it becomes a short duration instrument, but that also matches the profile of the underlying assets. And so I think it's quite unique to see the high level of interest levels of our listeners today. Then I think infrastructure, I think, is also an interesting one. I don't think there's enough interest and development in AUM over the last few years. It's one of the smaller ones within private markets. And private markets has grown tremendously over the last decade, anticipated to double again in the next 10 years. And I think infra will certainly contribute to that. Underlying drivers to that, US has approved trillions of dollars in infrastructure spending. But it's not just energy transition, roadways. It's also related to export credit agency loans and financing emerging markets and having a social impact on solutions. So I think as there's more focus towards responsible investing in many different ways, infrastructure will certainly pick up in both interest level, but also ability to deploy in the asset class, and seeing that AUM ramp up over the years. I do also want to touch on residential mortgages, because it was the lower one out of the mix, and it's not just local for local. So as we pointed out, that pension funds in the Netherlands allocate a lot. We also see Gotar and other European and outside of European investor interest in the asset class. And I think it's because it's very transparent on pricing, but with low unemployment, low delinquency rates, the performance has been absolutely stellar. And so with an uplift on public market comparison, it remains a very interesting asset class for investors, and we see that as a great opportunity in the years ahead as well.
Well, thank you. We just received a question in the chat, and I guess this could be one for Michael. How do alternative credit strategies fit into Solvency II regulation?
It's an interesting question, and it also is within our minds, and we have elaborated on this from the very beginning, and came to the conclusion that many of these asset classes we are currently talking about are very efficient when it comes to capital charges under Solvency II. For instance, especially the Dutch mortgage market or residential mortgage market in general has the opportunity, has the advantage that we will treat them under the counterparty default risk module as a granular exposure and leading to very low capital charges when it comes to the implicit credit quality that is underlying this asset class. So therefore, it's a very efficient asset class under Solvency II, and also trade finance is, from our standpoint, a very efficient asset class under Solvency II. On the one hand, the trade finance under the trade receivables business is, as Niels also confirmed, a self-liquidating short duration asset class with, in some cases, with an external credit insurance support, meaning you can have an implied rating that is very high depending on the credit insurer, also then leading to a low capital charge because it has a implicit high rating and a very short duration that is underlying the assets. And in addition, the export credit business is also very nicely fitting into the solvency framework because we have usually a 100% state guarantee of a EU or at least from a OECD country with high rating, and therefore leading to in most cases to a zero capital charge and offering additional yield over the respective state yield curve. So meaning it's also from a solvency standpoint very efficient investment.
Well, thank you very much, Michael, for that. And talking about regulation, I think where we see also increased regulation and discussion about it actually also leads to our next topic, because it's one of the most discussed topics. It's ESG. And well, looking at all our speakers today and the fact that all of their organizations do have in-house ESG expert, SAS it actually will. ESG is here to stay, and it will form an increasingly important part, and especially in alternative credit. So I would like to ask you, our audience, again, to answer the following question. What topic is most relevant to you when it comes to ESG? Regulation, a sustainable investment framework, integrating ESG into the investment process. Is it impact, making a real change, reporting, or is it investment risk? Again, we're looking forward to receiving your answers. And in the meantime, I think we also will discuss this hot topic. And I would again like to start with the investor at the table. Michael, is ESG integration indeed a must-have for your decision-making? And why is it so important for you?
Of course, it's a very important part in our investment process. And it has not been this important for a couple of months or only very recently, because as a credit investor, ESG factors, at least when it comes to materiality, have always been on our mind within our credit analysis. Therefore, ESG integration to some extent has happened before and have been part of our analysis also these days. And currently we are naturally integrating it more deeply and trying to figure out how can ESG integration can also help to improve performance.
Well, that's an interesting statement. Trevor, maybe from your insights, since you speak to investors globally, can you explain what motivates investors to include ESG into their alternative credit investments?
Yeah, sure. A little bit unfair to ask me that before the poll results come out, and then I'll be proven wrong maybe. But look, there are a variety of factors, right? And in some cases, the motivation is, in practical terms, it's external stakeholders putting pressure. In other cases, it's it's wanting to avoid reputational risk. Some people, either as an organisation or maybe the individuals in it, have a particular genuine mission to create impact. But I mean, hopefully, and increasingly, I think people are realising that there is a real financial risk associated if you don't take ESG factors seriously. Maybe in credit that's even more relevant because beyond the very the real and important impacts of on the planet and individuals on the planet of ESG. Ultimately, we are seeing the pace of interest in this pick up dramatically. There have been some, in Europe, there have been a lot of people who have taken it seriously for a long time, but it's becoming much more of a global phenomenon there. And we have to remember that the investments we're making now in credit, typically in most strategies, certainly corporate strategies, real estate and infrastructure, they need to be refinanced. They're not, they don't repay themselves. It's not like an amortizing mortgage. And when they're going to be refinanced is typically around 5 years' time. And for me, the biggest risk and a big financial motivation to incorporate ESG factors into credit analysis, beyond the standard, how credit worthy is a company, is really how am I going to get repaid? Because if I'm going to look to the market to refinance my debt in 5 years' time with the loan that I've made, I better be sure that loan is palatable to the market. And so if we're looking at something that's like pretty borderline today, given the direction of travel in terms of the seriousness with which people are taking ESG, there is a real risk already of getting stranded assets. And so you either better lend to a company that is, or a building or an infrastructure project that is ESG friendly, or you better make sure that it's got a path towards being ESG friendly within 5 years' time. Because if not, you really are taking an excess financial risk. So as well as some of these other, very worthy motivations, I think the financial risk for me is the most important. It might not be. I mean, in other cases, I wouldn't be surprised if reporting came up as an important factor, right? Because everyone's being held to account now. But that's the key thing for me.
Thank you. I think that was a very clear statement. Niels, listening to Trevor and Michael, what do you think? What are the challenges? Or are there maybe even more opportunities?
Yeah, there's lots of challenges that arise with some of the comments that have already been made. And how do you align investor specifications to regulation and then ultimately to the underlying investments? And they all need to match up to achieve the common goals, which we're all set to improve the overall impact around the globe at various levels. But I do think the challenges overall will generate further opportunity. I want to reflect on Trevor's comment as far as stranded assets. And I do feel that the universe of investable assets linked to ESG is opening up. At the moment, and we see this typically in volatile cycles, that there's almost an oversubscription or higher demand for defensive, non-cyclical investments. Now, in this current environment, ESG-related investment opportunities see compressed pricing because everyone is hungry for those types of investments. And in corporate loans, for example, we've seen 60% of the investments that we made this year with some association to ESG or sustainably linked loans. The market as a whole has tripled in the last 3 years. It's 350 billion at the moment and increasing at a rapid pace. So the actual investable universe is coming a lot more accessible, which hopefully will also moderate yield developments longer term. But I think the biggest challenge is ways to control data. And how do you report and monitor on that? But also, how do you analyze investment opportunities? And then I go to the comment of Gotar on how to improve underlying performance. And I do think it's the responsibility of all investors, including the asset managers, to monitor prudently and make a deep assessments on ESG-related factors, because that is what gives you the long, sustainable collateral position and cash flow generation to repay the loan positions. But I think the opportunity is far greater than the challenges, and I'm looking to a greater universe of investable assets in the future.
So, but I hear it's about really getting the data. It's about being transparent and having transparency and the increasing important aspects of ESG and reporting. So, maybe that's also again a good point in time to look at the poll results, and maybe we can again ask some of our speakers to elaborate on that one. And I think it's definitely interesting for Trevor to look at those results. Maybe Trevor, what do you think?
Well, I mean, I think it's very encouraging to see that making a real impact is what's motivating individuals who are voting, and you know that can only be a good thing for the world. I think so. You know that's very positive, and I'm also pleased to see that reporting isn't the number one factor. In fact, it's probably the last factor if I saw on my quick look at that bar graph. But ultimately, I mean, we do have to report, and we do have to have common frameworks, and we have to understand why we're reporting. You know what we're going to report on and why. We have to understand how data is being collected and reported on consistently. Look, I mean, I think making a real difference to the world and using the money at our disposal. I mean, I suppose it depends. Not everyone is investing, you know, as a pension fund for people's future retirement. But we're all sort of ultimately in charge of pots of money that are trying to generate long-term value. And the important point is that you know there are lots of global megatrends associated with ESG, meaning that you know, and the rate of change is so fast that I don't think there's any chance. It's worth taking any chances of thinking that you can just, you know, stick in bad assets for that excess return for just a little bit longer and time your exit. I mean, I think that moving now and moving into things that make a real difference is really important. Now, whether that's environmental, you know, which is clearly very important and clearly at the front of people's minds because of the forthcoming summit, or whether there are other factors that are equally important, such as diversity and inclusion, that actually can make a real difference to the performance of companies in the long run. I think there are lots of ways that the world can make a difference, but reflecting on those results, I think they make me feel more optimistic than I might have done if I'd have seen a different set of results, put it that way.
Well, but I think in general optimism is a very good thing. But I would like to come back to really the low figure on reporting and ask Michael, from the investor's point of view, how important is ESG reporting for you? And again, why?
Oh, I'm sorry, I was muted. I would regard ESG reporting as an important element in the equation because it gives us an opportunity to get inside the risk and the ESG perspective of a respective company and investment going forward. And therefore it's a very important part, but it has the problem that many ESG reports currently face a lack of standardization, lack of comparable data, and also, let's say, the some sort of verification, meaning that we would regard an ESG report more reliable if it would be audited by an auditor as well. And I guess this is something we look forward in the future to happen and to be implemented. Then it would be an important and integral part of our investment process, because it's also some sort of communication tool for a company if it has a strong ESG commitment and a strong focus and a strong purpose that are following, and especially this reporting might an important way to communicate this strategy.
Ronald, having listened to Michael, well, regulations actually aim to make the investment space more transparent. How will this shape the alternative credit space?
Sure. So at our company, AF Advisors, we have many people working on the regulation part right now and helping investors as well as asset managers to get ready for the future. And everything comes down to the EU action plan on sustainable finance. So there's a lot of regulation coming from that action plan, and one big one is of course SFDR, the Sustainable Finance Disclosure Regulation, and all EU managers have to comply with this regulation, so also the alternative credit managers. And well, Niels already mentioned it's struggling to get all the data together, but well, you have to be compliant with this regulation, at least if you're labeled your financial products as light green, so you're promoting characteristics of environmental concern or social issues. But it's even broader than that, because pension schemes are also labeled as financial products, so they also had to choose earlier this year for, what kind of sustainability label do they choose? Are they a gray pension fund, light green, or dark green? And we did a really small research project at AF Advisors, and we have found that of the top 50 pension funds in the Netherlands, 36 of them have chosen to be a light green pension fund. So what this means next year, when there's a new deadline on the technical implementation, they have to report on all kinds of metrics, such as water, waste, biodiversity, and CO2 emissions. So all these pension funds will demand data from their managers. And that's why many believe that the standard SFDR is setting will be on a global scale, because EU clients, they will demand this data also from their non-EU managers. So this is also impacting managers abroad. Well, coming back to the data issue that Niels mentioned, also from the EU action plan, his job will become a little bit easier in the future, because the EU demands companies starting from 2023 to publish data, audited data on ESG metrics. And well, to give you a general idea about how big this is, PwC, one of the big four accounting firms, they have announced that they will hire in the next 5 years 100,000 new ESG auditors. And well, they currently have 300,000 employees, so well, approximately a quarter of their company in 5 years will be working in ESG auditing.
That's a pretty impressive number.
Yes.
So we have received another question, and I first start with the question, and then the surprise will be who needs to answer. So do you believe that relative to public investments, private investments are better suited to embed ESG? Given the greater degree of direct engagement or for other reasons? Niels.
Yeah, that's an interesting one. I think we talked about transparency, right? And when you finance large corporates in a public bond market, there's a lot more data, and as a result, I would say instant transparency. But when we look at the poll results of wanting to make a real change, I think there's a lot more active engagement on the private debt side. Not to the extent of equity ownership, but certainly more active than a passive bond allocation. And so we finance all types of strategies, all types of corporates, consumer and government associated risk. And so with that engagement, you finance very small transactions, SMEs, mid-size and large cap corporations across a host of different languages, sectors, etc. And as a result of that, we've developed our own independent scorecards on the ESG side for the various strategies that we operate. And I think it's the direct engagement and the connectivity with our borrowers that allows for actually a lot more active dialogue on the sources and uses of the financing that we provide. So all in all, I think it's that active engagement that is quite favorable. The monitoring and reporting is still to come in a lot of instances, but it is an evolution. And I see that evolution going very much in the right way. And so, yeah, for those that are looking to make a real change, I would say private debt does offer a unique benefit in that situation.
I think this was a very nice closing remark, because this actually wraps up the end of today's session. I would like to thank Trevor, Michael, Niels, and Ronald for sharing their insights and especially their time with us today. And of course, a big thank you to you, our audience, for joining us from around the world. We hope that you enjoyed this edition of the Get Ready series. Should you have any follow-up questions, your NNIP relationship manager is of course happy to have a conversation with you. Furthermore, you will receive an email from us with a link to watch the recording of this webinar, together with a link to the evaluation survey. We very much appreciate your feedback on today's session, so we can take this into account for the next events. From our side here in the studio, I would like to thank you again for your participation today. We look forward to seeing you at our next event in the Get Ready series on the 2nd of November get ready for Outlook 2022 and beyond. Thank you for watching. Good afternoon and goodbye.